Happy New Year. I'm Carey Cooley.
And I'm Brent Kerwecker.
In this month's video, we're going to review 2022 performance and provide our outlook for 2023.
Yes, after 2 years of disruption due to the COVID-19 pandemic, we continue to find ourselves searching for some kind of return to normalcy. 2022 was a year of volatility that we have not experienced since 2008. The Fed spent 2022 aggressively fighting inflation by raising interest rates. When you couple that with supply shortages and labor shortages, we found ourselves officially in a bear market in 2022 by June. The market hit a bottom twice, both in June and then again in September. And the bond market for 2022 actually finished with its worst year on record. For the year, the major indexes finished as follows. The Dow was down 8.8%, the S&P 500 finished down 19%, the Nasdaq finished down 33%, and the Barclays U.S. Aggregate Bond Index finished down 13% for the year.
With this volatility comes the potential for opportunities. In response to the volatility, we focused heavily on dividend and capital gain reinvesting, along with helping clients potentially take advantage of down market through dollar cost averaging. Additionally, we're able to help many of our clients take advantage of tax loss harvesting in their non-retirement accounts, allowing for tax savings for this year and beyond. We continue to help clients purchase CDs at rates that we have not seen since 2008.
With the start of a new year, let's look at what we're currently forecasting for 2023.
The global economy will likely slow from above 3% to somewhere in the mid 2% range. The U.S. appears to have fewer headwinds to growth compared with Europe and other developed countries. We see the economy weakening in the first half of this year. If the U.S. falls into a recession, it's more likely to occur in the second quarter. Gross domestic product, we see this increasing at approximately 0.5%. Inflation, in recent months, durable goods have decelerated, but services and prices have been accelerating as rent prices and health services have risen. Our estimate is that inflation will end the year between 3.75% and 4.25%. In regards to stocks, if history repeats itself, stocks have tended to produce solid gains after interest rate hiking cycles end. Stocks on average return 10% 1 year later. Our current view is that the Federal Reserve will pause with rate hikes during the second quarter with a possible decrease by the end of 2023. We do anticipate continued volatility during the first half of 2023 as the Fed continues to raise interest rates and presses ahead with removing liquidity from the market. In regards to bonds, the path of interest rates will certainly be largely influenced by the Fed's rate decisions, guided by economic growth and inflation data. The worst bond market on record has pushed yields to some of the most attractive yields since 2008. We expect bond yields to remain elevated until interest rates begin to decline.
As we go into 2023, let's look at some of the potential opportunities we see in the markets. A slowing economy tends to favor long-duration treasuries, as they have historically performed well in recessions and could provide diversification as the economy weakens. Higher interest rates have lifted yields in the fixed income sector. Yields on high-yield bonds are attractive relative to recent history and appear to be supported by strong fundamentals. We also see potential opportunity in the municipal bond sector. Small cap stocks appear to have priced in a bit more dire economic scenario, but potentially will offer more upside when inflation and growth outlooks improve. Equity valuations are much more reasonable, but earning expectations are likely going to be flat for the year. We're a bit more cautious right now with growth stocks for the first half of the year as the Fed continues to raise rates. We are continuing to focus on quality companies and core equity funds that have a track record of paying dividends. For the next decade, we see potential opportunity in automation companies, lithium battery manufacturers, and the many sectors tied to the electric car industry. In regards to potential opportunity, you'll see on your screen the S&P 500 performance for the last 42 years. If history repeats itself, down years tend to be followed by consecutive years of positive performance, and therefore a patient, long-term investor is rewarded over time through dividend reinvestment and dollar cost averaging. For example, if we look at large cap growth funds, They've averaged 14% per year for the last 10 years, even after being down 29% in 2022.
Clients, we look forward to an exciting new year full of potential opportunity. Thank you for choosing Cooley Godfrey Investment Group, where we believe in providing financial guidance and strategies for life. Stay tuned for our next video in February.